Hey everyone. Ever wonder how gold futures work? You hear about them in the news, but what do they actually mean? Let me break it down in the simplest way possible. A futures contract is just a deal. It says I'll buy or sell something like gold at a set price on a set date in the future. You're basically locking in a price today for a trade that will happen later. Let's say it's April and gold is trading at $3,000 an ounce. You think gold is going to go up by July, so you enter a futures contract to buy gold in July at that $3,000 price. Now, if July comes and gold is at 3,200, you still get it for 3,000. That's a $200 profit per ounce. But if gold drops to $2,800, you're still paying 3,000, so you take a loss. Let's say you're a gold producer. Maybe you run a mining company. It's April and gold is trading at $3,000 an ounce. You're worried prices might fall by July, so you enter a futures contract to sell gold in July at $3,000. If gold drops to $2,800 by July, no problem. You still get to sell it for $3,000, just like the contract says. You avoided a big loss. But if gold rises to 3,200, you're still locked into selling it for $3,000, so you miss out on higher profits. That's the trade-off. You're giving up the upside, but protecting yourself from a drop. That's why sellers use futures, to lock in prices and hedge against risk. That's how futures work. You're betting on where the price will be in the future, not where it is now. But here's the cool part. You're probably not actually buying or delivering real gold. Most traders don't want the metal. They just close the contract before it expires and take their profit or loss in cash. No gold bars showing up at your door, just numbers on a screen. So who uses gold futures? Hedgers, like gold mining companies, use them to lock in prices and protect themselves from drops in the market. Traders and speculators use them to bet on price movements and try to make a profit, often using leverage, which means bigger potential gains and bigger risks. And remember, every gold futures contract has an expiration date and covers a set amount of gold, usually 100 ounces per contract, traded on exchanges like COMEX. So let's recap. 1. You lock in a future price today. 2. You make money if the price moves in your favor. 3. You lose if it moves against you. 4. Most contracts are settled in cash, not physical gold. 5. And it's used by both professionals and traders for hedging or speculation. That's it. Gold futures simplified.